Let's bring in Tom Lee, Fundstrat co-founder, managing partner in Fundstrat Capital CIO, and I can just see you. This is Tom playing out exactly as you said. Choppy. You said exactly this. You said choppy for how long, but then the S&P again starts moving, and this is not, I don't think, an obvious or a logical conclusion to have right now with all the bad news that we're hearing about these policies. Everybody thinks the market's headed lower.
Yes, but instead we could be bottoming, maybe this week.
And this is the choppiness you were talking about. And, you know, I think you use a combination of fundamentals and technicals, obviously,
yes,
to get things right. And the reason for the choppiness was going to be the first 100 days of this fire hose of executive orders and everything else.
Yeah, that's right. It's kind of weighing on investors' minds. We're seeing it even in the surveys and CEOs because the tariffs and DOGE are, you know, the DOGE is creating austerity. Tariffs are creating uncertainty. Businesses are maybe sort of sitting on their hands. This is why I think markets have been sort of sinking and momentum has done so poorly. But to me, Friday was a good day because, you know, it was a bad news headline, but markets actually rallied.
Yeah, World War III is usually not a good headline
yes,
for financial markets, or a continuation of a very expensive, you know, guns and butter. Using guns or using weapons and depleting them and having to rebuild them and everything else might be good, I guess, for the economy. It doesn't seem like a great thing. I'd rather be spending it on AI or something like that, wouldn't you?
Yeah. I think, or even rebuilding parts of the, you know, the U.S.
Right, exactly. So from here on out, you think we bottomed? Have we seen the lows already? Because we didn't get worse than, what do we get, 5% on the S&P as far as the drawdown?
Well, I think investors are going to be kind of watching out of the corner of their eye because Friday is the jobs report. Last week, consumption kind of raised concerns that maybe we're slipping into a slower or downshift in speed. So if the jobs report's really weak, there could be some panic.
I would think that it would be, I mean, you know, we know about these crack addicts in the equity pit. They want more rate cuts. I would, if it's not too bad, just soft a little bit, and it brings back the prospect of more than one or two rate cuts, I could see the market rallying on that.
Yes, that's right. I think if the job report is bad and maybe we initially panic, like even that day, then everyone's going to rethink and realize not only is the Fed put back, because the Fed now will need to cut, but I think that some of the things that look like the White House wants to slow the economy, they don't want to get to stall speed. So then the White House, I think, the Trump put comes back. So I think it helps markets.
Isn't the bar very high, though, for Fed rate cuts to be back on the table? I mean, let's say we do have a softer jobs report. I mean, the Fed and many Fed officials have said that the tariff issue they would look through. And so even if tariffs put grit in the economy and we have a softer sort of economic backdrop, that may still not be enough for the Fed to do anything. So that Fed put may not be worth much.
Well, I think it just depends on what the job number looks like. You know, the Fed has not worried about the labor market being inflationary, but they would certainly worry if unemployment's picking up or if we have a negative jobs report. I don't think it's negative, but something, you know, it could be well under 100,000. And if it is, I think the Fed would actually have to get off their hawkish paws.
What is a fundamental and the technical backdrop for bottoming happening this coming week?
Well, you know, I think the best way to define a bottom, and Tom DeMark has mentioned this before, is stocks rise on bad news. And so Friday was maybe the first sign of bad news, the market's bottoming. But I know our technician, Mark Newton, doesn't think we're there yet. He wants to see more signs of exhaustion. But we've seen sentiment turn negative. So yeah, maybe Friday, you know, but it could have already bottomed too.
The buzz around Nvidia has hit a crescendo following its fluctuations in the stock market. As investors grapple with a market-wide sell-off and the broader AI race, Nvidia has found itself at the heart of these seismic shifts. With its stock plummeting over 20% from its peak, placing it squarely in bear market territory, the financial world holds its breath. Yet, amid this apparent downturn, whispers of remarkable potential linger, driven by Nvidia's pivotal role in the AI revolution. Figures like Rosenblatt's Hans Mosesmann and Tom Lee fuel the intensity with lofty price targets projecting massive upsides. What fuels such bullish predictions, and what makes Nvidia an intriguing prospect despite the current market distress? Welcome back, everyone, to Investocracy.
The fear here, and I think you're seeing on the Nvidia sell-off, is that this is going to be a huge ripple effect. It's going to be harder and harder to get those chips. That's something, even though there's the China piece, it could have a much broader impact across the region. I think bark's worse than the bite. I mean, as someone, in Asia for 2 weeks, I think it's when I get the fears, but I don't think this is something that's really going to be as much of a restrictive factor, despite everything we saw today.
Do you think it's deep-seek concerns that are spurring this next wave, potentially, of regulation? And I guess perhaps just as importantly, has the train already left the station when you look at homegrown chip development in a place like China?
Look, I think DeepSeek, that was a shot across the bow, because I think everyone recognized, okay, they didn't do this in the basement with no chips. And it comes down to, if they use next-gen NVIDIA chips, what does that mean? And I think, look, the broader fear, especially that you see in the Trump administration, is, okay, we got restricted more and more. So I think what you're starting to see from an investor perspective is, okay, what does this mean for NVIDIA? Second derivatives. Is this going to crimp the supply chain? Now, we disagree. I think when it comes to tariffs, we've seen many times, this is one, it's going to have an impact, but I do not believe it's going to have such a pronounced impact. I think it's being factored in here in terms of supply chain. Still 15-to-1 demand to supply, even when it comes to Blackwell.
Well, okay, bark is worse than bite, but still a bark can be pretty bad if it hurts sentiment, right? If it sort of puts a wet blanket on the party, has an impact on valuation. At what point does it start to do that? And do you have to, if you're an AI investor or even NVIDIA investor, have to get less bullish?
Yeah, look, I mean, no doubt you're going through a lot of turbulence here. From a sentiment perspective, you're seeing the stock, then it becomes self-fulfilling prophecy. But what I'll tell you is it comes down to just demand. Do we see any changes in spending? That demand's going to continue to be there. And I think it's when there's only one chip in the world that ultimately could fuel this. I get we're going to go through this, but in my opinion, these are opportunities, not the time to run for the hills. I think when you look at it in terms of tech winners, if you look over the years, it's period like this and these white knuckle periods that you own the winners, you own the NVIDIAs.
Industry experts and investors, including Microsoft CEO Satya Nadella, argue that with the expansion of efficient AI models in the market, could be beneficial to players like Nvidia. Recent data culminates this narrative. Nvidia's anticipated 65% revenue growth in Q1 alone provides a telling testament of its upward momentum. Forecasts for 2025, banking on this ascent, paint a compelling picture. Analyst predictions sit comfortably at expectations of $204 billion in revenue, a staggering 56% jump. Nvidia's stock, currently perched at around $110, carries the potential of leaping to $220 as estimated by Mosesmann. Should you be questioning such hefty figures, consider that Nvidia's historical PE ratios, hovering around 60, evidently support substantial growth prospects. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
Let's talk more about tech in light of yesterday's market sell-off. For insights on the mega caps and more, let's bring in Dom Rizzo, portfolio manager of the Global Tech Fund at T. Rowe Price. Dom, thanks so much for joining us. Good morning.
Good morning. Thanks for having me, guys.
Yeah, I want to pick up where Dom and Becky just left off there with NVIDIA. Calls for at least maybe some opportunities in terms of valuation. Do you think NVIDIA is more attractive right now at this valuation, or do you think there's still some legitimate concerns out there about AI, DeepSeek, and lower price models?
Well, I really think NVIDIA is quite attractive here, and there's a couple of reasons why. Well, let's take a look at the valuation first. The stock is trading in line with the SOX index now and is trading at only a slight premium to the S&P 500. If you look at it historically, that's historically where the stock's bottomed on a valuation perspective. But more importantly, we have improving fundamentals from here. Gross margins for NVIDIA should probably bottom in the April or the June quarter and improve to that mid 70% level as we head throughout the rest of the year. And then if you look at the supply chain, things are actually looking really positive for NVIDIA. So, Han Hai reported its February numbers this morning. They're the biggest, partner for Nvidia, and the February numbers were up 56% year over year in terms of revenue. And then if you look at the fundamentals of other parts of the supply chain, memory prices are starting to increase for both DRAM and NAND, both up mid-single digits off the bottom. And then finally, probably most importantly, if you look at Nvidia's revenue growth from here, we're going to just keep seeing sequential acceleration. So I kind of put it together, and I like the setup in the stock.
Yeah, and we had that raid in Singapore where it turns out that the chips being sold to Singapore were finding their way in China. Do you think the administration here and what they could do with Nvidia further restricting chips, even perhaps the cheaper chips that they're allowed to sell to China right now, should that be a concern for investors at all?
Well, looking at the fundamentals, what's happened since DeepSeek, if you look what's actually happened since DeepSeek, is NVIDIA demand has gone through the roof, both in China and in the U.S., right? So if you look at the supply chain, H20s, those cheaper chips you were referencing, the demand for that has really surged since DeepSeek. And then if you look at what's happening in the U.S., Hopper pricing and all the pilots has gone up. So NVIDIA is clearly the biggest negotiating leverage tool that Donald Trump and the administration have with China. It's one of a few. And I think it'll probably be part of a grander bargain in terms of the China deal.
Dom, when you look at the companies that are doing all of this spending, and obviously the customers of NVIDIA, like the cloud platforms, really interesting divergence in terms of how the market is treating them. You have Alphabet right now trading at a 10% discount to the S&P. Rarely seen that through history. Meta, on the other hand, has seemed like it's gotten it all figured out. Are there opportunities you see in those divergences, or how do you think about that group in general?
The issue with all the hyperscalers right now is that CapEx intensity has to continue to increase, right? And frankly speaking, NVIDIA is going to capture a lot of that economic value from that capital intensity increasing. I think the reason Alphabet struggled so much is really a function of its search business more than anything else, right? Just think about your personal day-to-day experience. How much more are you using ChatGPT and Perplexity relative to Google search? My gut is probably a lot. And so that search business is so big. And if you look last quarter, that grew 12% year over year. I'm not sure that search business can continue growing at 12%. So yes, I like YouTube. Yes, I like the cloud business, but it's really the search business that is under attack, which has historically been one of the best businesses of all time, frankly. And if you look at Microsoft and Amazon, all three of the hyperscalers were capacity constrained this quarter. They actually would have sold more in their cloud business if they had more chips from NVIDIA. And I think that's partially the Blackwell delay, which should improve in Q1. And so of all those three, I personally think Amazon's the most attractive. We have a few different moving pieces for Amazon, but most importantly, I think operating margins continue to improve throughout the year for Amazon.
Historical figures showcase a journey from a mere $2.97 EPS to projections of $4.50, heralding further accomplishments without missing a beat. The possibility of Nvidia effortlessly achieving an EPS of $5.72 by fiscal year 2027 underscores the potential trajectory outlined by optimistic analysts. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
I think we're, in the same mindset that we'll get on the other side of this at some point, probably in the second quarter. I just think it's hard to get through it until we really understand. If you're the CEO of a company that's a big company and you've got facilities and customers in Canada and Mexico and China, et cetera, I just think you're a little bit, I like his phrase, sitting on your hands a little till you understand a little bit more about how to most productively deploy capital. I think that usually takes probably through April earnings and guidance, and then I'd probably kind of be more optimistic that we have a certain path. So we're in the close enough for, government work, if that's a thing.
Well, you might be losing.
Yeah, exactly. We might get dosed.
I don't know if that's so bullish for you.
I'll take Q2. I'll take Q2.
It's one thing for CEOs to be a little skittish, be a little more cautious. That's what they get paid to do. Investors often have to place their bets before something takes place. Is this a buy, this unsettled market that we've witnessed recently?
Yes, in my mind, we put out a piece yesterday just talking about the 10 best days that happen every year. Last year, for instance, the 10 best days added up to 21 percentage points of the S&P. X those 10 days, the market was only up 4%. So, you don't get 20% years because it's good through the year. It's just the 10 best days. I think the setup for a 10 best day is near because if the economy's near stall speed, I think people realize the Trump put does come back because otherwise it has to unwind all this austerity. And if the job market's soft, the Fed put comes back into play because the Fed doesn't want to play with stall speed. And I think that's what is going to be the positive catalyst in the next couple of weeks. And on top of that, we already know stocks will bottom before bad news peaks. And so if we're seeing the market not fade on bad news, that means we're already priced in a lot of things that would scare us.
As Nvidia navigates through the whirlwinds of the stock market, the case for investment emerges with clarity. Despite its recent downturn, Nvidia's foundations in the AI revolution suggest a hardy resilience. As sectors prepare to ramp up AI spending, Nvidia stands as the steadfast benefactor of this accelerated digital maturation. Indeed, Nvidia's journey is far from over. While hitting the $220 mark over the next year may be ambitious, the extended outlook renders it achievable, emphasizing competitive prowess and solid financials. How do you envision Nvidia's place in the stock market's future tapestry? Share your thoughts on Mosesmann and Lee's predictions on Nvidia's shift towards new altitudes. Finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.